Well, when Pepsi reported its latest results, it did something it doesn't typically do. It missed sales expectations as the beverage and snack giant reported a surprise decline in revenue, and its forecast for sales growth was also below expectations. This is a company that has been dealing with sluggish volume growth, offsetting that with price increases, but it seems like they don't expect to increase prices to the extent that they have in previous years. Let's bring in Gerald Pascarelli, analyst at Wedbush, who covers Pepsi. Gerald, thanks so much for being with me. Obviously, that's the anxiety, right? That slowdown in growth and maybe their ability not to meet that with price increases. Do you think those fears are kind of overblown at this point?
Well, I think the weakness that you see in the shares today was, predominantly driven by the fact that last quarter, Pepsi had offered preliminary guidance where they had expected 2024 revenues to come in at the high end of their long-term algorithm, which for them would imply about 6 percentage points. It was a bullish outlook, and then today they had revised down that guidance to at least 4%, so kind of the low end of what would be a mid-single-digit growth rate. And so, for a company like Pepsi, who's established a reputation for a company that under-promises and over-delivers, I mean, I think they've had 56 consecutive quarters of meeting or exceeding street expectations, and they very rarely guide down. So that came as a little bit of a surprise, and I think the shares are being somewhat put in the penalty box as a result. But I think, to be fair, the volume outlook has not improved to the magnitude that management probably expected it to when you started to see the moderation in these price increases, which we're at all-time highs over the past 2 years to combat commodity inflation. Is
there a concern that slowing growth and price increases actually starts to translate into having to cut prices, and you're talking about outright deflation at the company?
I don't think there's discussions of cutting pricing, but again, you're comping and you're cycling double-digit price increases. I think that what you see right now is really just trends reverting back to a pre-COVID level, where when you look at the revenue drivers, you had a better mix between volumes and pricing. The past couple of years, it's been 100% pricing at the expense of volumes. And so as you moderate your pricing, the assumption is that volumes are going to improve just because it gets a little bit easier for the consumer to digest. But that has not yet come to pass. And if you look at their expectations on the year, they really expect the consumer, even though the consumer has kind of shown their resiliency, they expect the consumer to get a little healthier as we get into the back half of the year here. So this will be a back half weighted year for Pepsi.
And so you see 15% upside in the stock according to your price target. And where does that optimism come from? What's happening in the back half of the year?
Yeah, I just think that when you look at any of the soda stocks, there's a lot of bad news that's already priced into these shares here. At first you had the emergence of a potential GLP-1 risk, which did not help sentiment. You have the guide down today. And so if you look at Pepsi's PE multiples relative to like a 3 and 5 year average, it's well below. And the other thing is that these 3 and 5 year averages are very consistent with one another. And so, we suspect that these stocks will grind higher, in the event Pepsi's able to deliver on their current expectations after resetting, which again is something that they've proven they can do consistently. Grind higher stocks as you get potential beat and raises on the bottom line here going forward.
Do you think that as you mentioned that risk of the GLP-1, so those diet and obesity drugs, you have to be thinking about that, right? Like, when does it start to show up? I know that they say we have a bunch of healthy other offerings, but they still do make chips and soda. You have to expect that that's going to start to affect the business.
It really all depends on the adoption of the amount of the population that starts to take these drugs. We put a survey out on this last year, and it's about 2 to 3% of the population is currently on GLP-1 medication. It's incredibly expensive. to use it for cosmetic weight loss purposes. And so it's one of those things we're monitoring where if pricing for these drugs come down, adoption rates increase, then a company like Pepsi would certainly be exposed, because not only do they sell beverages, but Frito-Lay North America is over 40% of their profits. And so, one of the things that Pepsi speaks about, which is important, is they talk about driving smaller pack sizes. That's something that they really have been focused on, like with the movement into health and wellness. But they really, I would say, focused on it over the past few quarters, where you are seeing, them focus on driving smaller pack sizes, which would be margin accretive on a per ounce basis, but impact your headline volumes. And so, the more smaller pack sizes and portion control that Pepsi is able to drive today, when it's really a non-issue, the better they will likely be positioned, if adoption of these drugs do become more widespread.
Good old shrinkflation there, which I know consumers have talked a lot about. You are broadly positive, not just on Pepsi, but on this space in general, like a Coca-Cola, a Keurig, Dr. Pepper. I noticed the alcohol companies that you're relatively more neutral on.
Yeah, typically when there's questions about the macro environment, beverage companies, consumer staples in general, but really beverage companies it's a defensible call. These are needs-based products. There's few substitutes, and so we like the defensible nature of the soda companies. We also like the relative valuations. I spoke about the PE multiples being well below the 3 and 5 year averages for Pepsi. They're below for both Coke and Keurig Dr. Pepper as well. And so we like these companies for on relative valuation, but understand that it's trends are slowing from abnormally high levels over the past couple of years.